Good afternoon, everyone. David Scherer, Co-CEO, Co-founder, Origin Investments. I'm excited today to be joined for the second year, I believe that's accurate, by Jay Parsons, who's someone that I certainly look up to as a leader in multifamily econometrics, forecasting. I'm going to do a brief bio on Jay. I don't know if everybody here knows, but it's kind of ironic that I'm doing his bio because I'll kind of skip to the end. He has 500,000 impressions on all of his posts weekly. So he's certainly getting out in the world. He was named one of the top influencers of 2023 in multifamily real estate. He's a housing economist, advisor, writer, speaker, and has advised numerous multifamily and single-family rental housing stakeholders from institutional REITs, investors, smaller investment groups, lenders, et cetera. Jay's also been cited in the Wall Street Journal, Bloomberg, Financial Times, The Economist, the New York Times, NBC News, Politico, and has appeared on CNBC, Bloomberg TV. He's also been published in Barron's, et cetera, et cetera. So, Jay, I'm gonna stop just because there's so much to go over. Let's jump in.
Let's do it.
I know that last year was sort of a transition year, and when we did this at the end of 23, Origin, we had been on the record for quite a while, actually saying, we expect this to be a really tough year in terms of supply, demand, and ultimately rents, occupancies, et cetera. And that proved to be correct. Looking back, do you it's always easier to look back, right, than to look forward. But looking back, what was your opinion going into 23, 24?
Yeah, I think there was some things we were right about, things that I was wrong about. I think on the things we were right about is I was very bullish on demand, and there's been a lot of demand, and I don't think it's just about people not buying homes. We're seeing a lot of demand coming in to rent apartments. And this is going to be the second best year for net absorption since 2020, other than 2021, going back 3 decades. What I've been surprised by, I was wrong about, is primarily on the retention side. We saw very strong renewal demand for apartments. What I was less surprised by, kind of neutral, kind of about in line with expectations, was rents. It was a soft year like everybody expected. Basically 0% nationally, and seeing low single-digit rent cuts in a lot of the higher supplied markets. So yeah, it's been an interesting couple of years, and sets us up for another interesting one next year, I think.
Yeah, absolutely. And we'll jump into forward-looking. But I guess the first question I would ask is, what surprised you the most about 2024, looking back?
I alluded to this a little bit. It's definitely the retention side. So, just looking at going into the year, you have a 50-year high supply wave hitting the market. And that means you have rent cuts, you have concessions, you have a lot of brand new properties offering discounts. We saw this filtering impact. We see even the Class B and C properties in these higher supplied cities are cutting rents to be competitive. And so in that type of environment, you expect to see people do what's usually in their economic best interest, which is to go find a better deal. But what we found is a lot of them chose to stay put. We actually saw retention rates go up. And I think what we saw was, number one, across the industry, there's a lot of focus on heads in beds, protecting occupancy's cash flow, and that paid off. But number two, I think what we also saw is that in most places, the depth of the rent cuts really wasn't significant enough to really encourage people to maybe save a few dollars and take on the cost of moving. And then the frictional cost of relocating. And on top of that, too, I think after a few years of large renewal rent increases, we saw people are getting more normal 2%, 3%, 4% renewal offer letters. And they're saying, hey, you know what? That's a good deal. I'm willing to pay that and stay put. So that seeing above normal retention rates this year, that was a big surprise. And I think also speaks to the underlying health of the industry and to the renters specifically in market rate professionally managed apartments.
Yeah, I would add on to that. What I was most surprised by, but I think it relates to what you're talking about, I was most surprised by how strong demand was, and we had record supply this year, but it was met by record demand. And in my opinion, the record demand is going to persist and the supply isn't. And we'll get to
Yeah.
that because I think we have an imbalance that's coming. It's going to be quite good for apartment owners and investors in apartments. But this year, like looking back, what surprised me the most was the resiliency in pricing in the for sale housing market. And there's lots of reasons for that. People are trapped in mortgages that are very. I mean, it's kind of interesting to say trapped because they have an asset, right?
Yeah.
They have this mortgage that's way, way below market. Maybe it's 300 basis points below where the market is today, but they're they're not going to trade out a 3 or 4% mortgage for a 7. And so there's just not a lot of supply, and that's keeping pricing high, even in the face of higher insurance, higher interest rates, higher. It's very expensive. And can you just let's transition into this conversation about the price of home ownership versus a like kind rental at this point, and because I think it really matters. It relates all the way back to your point, which is retention rates.
Yeah, no, it's a part of the equation, absolutely. And what we've seen happen is, it's funny just to kind of tee this up a little bit. Everybody thinks when we talk about this, see headlines about it. Everybody thinks it's about mortgage rates. And honestly, this rent to own gap started to really widen to historic margins before the Fed started increasing rates, and that's because home prices appreciated a lot faster than rents did for reasons we get into. I mean, the demand was great for both. But you think about the pricing. I mean, the bidding process of a single family home really drove up prices much faster than we saw rents. And then you get to the couple things happened after that. You saw rents started to stagnate as supply hit the apartment market, but not the for sale housing market. And then, of course, we have the higher mortgage rates, where now you have an additional cost associated with it. So you look at nationally, there's some great data from John Burns that shows us that for an average apartment rent is now about maybe $1,600 more than your the all-in costs, monthly costs for buying a house. So that includes your PMI, your maintenance costs, your mortgage, taxes, everything. So that's a lot. And even for a single family rental, it's about, I think, almost $1,000 right now a month. And so, at the end of the day, I mean, renting or buying is not just a financial decision. It's also a lifestyle one. So it's not the only factor. But certainly, you get to numbers that big and it becomes a deterrent, particularly because most of the time people don't just want to buy, but they want to buy in a certain neighborhood, a certain type of house. And oftentimes to rent in the same area, that gap could be even more significant. So it's a big part of the equation.
Yeah, I agree with you that buying a home isn't just a financial decision. Of course, it isn't. However, because homes that people want to buy aren't affordable, it is a financial decision. I can tell you countless stories about people that are very successful and they earn a very significant income, but they're living in these high cost cities. Denver would be an example, but there's many others, Nashville, lots of these cities, and they'd like to buy a home, but they can't. The starter home is $700,000, $800,000, and all in, and you need a down payment. So I agree with you, Jay, that it's absolutely more than a financial decision. However, for a lot of people who are quite successful, it is a financial decision because they can't do it.
Yeah. No, yeah, no, I definitely think that's part of it. But I think there's also other factors as well, which is, and the reason I always tell investors, like, I think if we focus too much on just the financial aspects, then it goes the other way as well. Eventually it's gonna get more affordable to buy a house again. But I think for investors, there's another factor here, which is that people are typically, even before the mortgage rates went up, home prices went up, we were seeing these structural shifts. People were waiting longer to get married and have kids and, get to that single family stage of life. And so I think that's a macro driver for apartments. And I think also we've seen in surveys of Gen Z, at least for the stage in life, is they really put a big value on flexibility, and they view a mortgage as being tied down to one spot, and they may want to move. And so they see it differently than those of us who are, in our 40s, 50s, and older, who prefer to be in one place maybe for a longer period of time. So I think there's a lot of factors that go into it. So I don't want to downplay the financial side, but I think it's one of many factors in the equation here.
Yeah. If I go back to the predictions article that I wrote 2 years ago, one of my predictions was I thought that the for sale housing market would correct, and I was wrong. And I just candidly, I didn't see that coming. I didn't think I expected rates to go quite a bit higher. And that I was correct about, but I thought then it would affect for sale housing, and it didn't. And that's been surprising to me over the last 2 years, that the depth of the resiliency of that market is really, it's something.
Yeah, and I'll give it a part of it's the supply side. I mean, this actually feeds into one of the common myths I hear about, rental housing versus apartments. The truth is the problem in the country on the for sale housing side is we have not built nearly as many homes as we've added homeowners. So what meaning is that over the last 8 or 9 years, we've added homeowners at a faster rate than we've built for sale homes, and so the homeownership rate has gone up. And this is census data, not mine, not industry. This is the government's own data. And so that it's created a structural, this kind of push of growth in homeowners over single family homes has actually decreased the supply of single family rentals. And what that's done is put more upward pressure on prices. So even with reduced demand out there, reduced velocity in the market, you still have a lot of pent up demand for single family homes. And that's really, that undersupply is really propping up pricing, even in a high rate environment.
So let's transition to forward looking. For 2025, what are you most certain of the headline will be? Pick a headline that you're very certain of that is coming up, and let's build out that conversation.
Well, I think if you start with the most obvious one, I mean, the thing I'm most certain about is that supply is decreasing. And I'm picking the easy one because I think it will be the story, especially second half of 25 and in 26 and 27, is that not only is supply decreasing, but it's going to decrease and go down hard once we get this current wave behind us. And I think we're going to look at this and say, hey, this wasn't just high supply. This was once in a generation supply. And I think the more time goes on, these properties lease up and the market recovers. There's a lot of downstream factors, but it's all, and the capital markets as well. It's all going to stem from the reduction in supply.
Yeah, and I can't. I'll just add on to that because you and I agree on this. And by the way, for those that are joining us, and thank you for joining us. I think we had close to 1,000 today, either investment partners or prospective investment partners. This notion of supply decreasing, this isn't conjecture. This isn't like we know how much supply is coming. That's the part of the equation that's certain because it's based on starts that did or did not happen in 22 and 23. And I've talked about this at length, but I'm never certain who's on which webinars. But so I'm just going to spend 1 minute on it. When the Fed started raising rates, new starts went down. And that should make sense because the cost to borrow is going up. The cost of equity should be going up too. And by the way, at the same time, construction costs were going up. So all of the sort of inputs into a development equation were going against the developer. And so equity is less certain to invest. Lenders are less certain to invest. So that started to happen in 22. But then, by early 23, when Silicon Valley Bank failed, that was the death knell. That was, I believe, February, March of 23. And so if you think about, what happened here, the Fed was determined to reduce the money supply and they started raising rates aggressively. And if you think about how long it took to break something, it took about a year. They did a quarter point in early 22. By early 23, SVB fails. And they failed because they had invested in bonds that were eroding in value quickly, run on the bank, et cetera. Why is that important? Because all the other regional banks see this. They see a fairly well-capitalized bank vanish overnight. And by the way, a lot of other banks were close. PacWest was close. Others they were close. And the Fed stepped in again. And so all the regionals at that point were like, look, we've got to hoard our cash and our deposits. And it was kind of like a fight for survival. From that point on, there was almost no starts. Why does that matter? We're approaching 2 years now. I mean, that was Q1 of 23. We're almost 2 years later. And I remember, Jay, early on, we were having these internal conversations because the data is always late getting in. It's always clear, but it's 6 months late. It's always late. And I was talking to committee and I said, look, like I travel, we have offices all over the country, and I'm in these markets all the time with these teams. There are virtually no starts. I don't care what data you're looking at. It's not happening. Like when, in a city that used to produce 20 starts, there's one or two. And now it's much more clear. And I know you've written extensively about this, but we don't get those back. We've lost 2 years of starts that should have happened. So what do you think? I mean, the only thing, in my opinion, that we can be wrong if demand also goes down to meet a lower supply, right? That's the only way we can be wrong. And what would cause demand to go down? And I'll leave that to you. And why would that happen?
Well, let me say one thing. One of the questions I get a lot about is, hey, is this just a temporary pause or a long-term thing? So if we're talking about demand, I just want to point out it's not just like the start. It's even the indicators before the starts that are showing signs of sustained slowness. There's a great index that the American Institute of Architects maintains on billings. And then before you could actually start a project, you got to have a plan for it. You got to contract an architect. Those billings are not just low, they're still trending down from already low levels last year. That's a really early indicator of what's happening. Permits are trending downward. You look at the Federal Reserve Senior Loan Officer Survey of banks. They're not yet loosening their standards for construction loans. They're not seeing more demand for construction loans yet. And so these are all very early things that have to happen before you have more starts. And by the way, the other thing is that the rents, I mean, we talked about rents a little bit early on, like you can't really build more until the developers have a target to what they're building toward, but that's still a moving target. They don't know what the rents will be yet because we have to see when these units stabilize and on down the line. So there's a number of things that have to happen. So I think we're going into not just kind of back to normal supply levels. I mean, we're going to go to, I think numbers look more like the first half of the 2010s decade and the second half of the 2010s decade. And it's probably going to be a few years of that before we start to even see, some moderate pickup again. So I just want to throw that out there.
Yes. So the only thing I see that could lower demand, there's really two things. One is if we went into a deep recession, that always lowers demand. You see less household formation. And if you think about, for the viewers watching, you always have a need for housing. That's why I invest in housing. That's why I like this space a lot. It tends to have less volatility than any other real estate asset class because it's an essential consumption. You need shelter. However, if we go into a deep recession, you're going to take on a roommate and you're going to share that. Or, I was around for the Great Recession. People moved back in with their parents, right? And so you see delayed household formation. So that's one way to lower demand for housing. It doesn't appear that that's happening. Right now, we're looking at a world where inflation, and we'll get to this later, but inflation seems a bit stickier than the Fed hoped. And the economy is actually extraordinarily resilient. And we'll get into that. But there are no signs right now that the economy's slowing, so that doesn't seem likely. The other thing that could affect demand would be any form of population loss, right? And so, which would include deportations, that's population loss. Any of those things can affect demand. Like the thing we need for long-term growth in the multifamily space or the housing space is a growing population. I mean, that's your demand segment. Why we at Origin invest in the growth areas of the country, I'm looking at your map, Jay, but Florida, the Southeast, Texas, the Southwest. So basically the whole lower end of what you're sitting in front of is because even though the US is a slightly positive population growth country, but slightly, but that makes us way ahead of other westernized economies that are negative. We're doing better than Europe. We're doing better than China and Japan and Russia. But in our states, you're seeing massive inflows, right? And that as an investor, and I have a long-term perspective, that's what I'm focused on. We just got a question in, and it's specific to Austin. And the question was, what do you think in 25 for rents in Austin? So I'll just stop. What do you think? It's a very specific question.
Yeah, I think Austin will be one of the last markets to bounce back. It's one of the highest supplied markets. It's a very volatile market to begin with. People outside Texas don't always realize this, but Austin's a smaller market. It's a lot smaller than Dallas and Houston, and there's a lot more supply in a tighter band of an area. And so you're going to see more volatile swings. It did better in the lower supplied environment. It's going to do worse in a higher supplied environment, and it's going to bounce back eventually and be among the rent growth leaders again as supply tapers off. But I think it's likely a market that's still, likely in the red in 2025. I think it'll probably get incrementally better. I think it's at -8 right now, maybe lower single digits rent cuts, but you still have enough supply to work through and concession burn off that has to happen first. I mean, it's probably going to be 26 before that one starts to bounce back.
Okay, that's what's cool about these webinars. So I'm going to leverage Multilytics, and that's our proprietary machine learning. It's something we're really proud of. It's been very accurate for the last 4 years. And Multilytics, and I also believe that Austin will turn around in Q3 and Q4 of next year. I think Jay and I agree that into 26, 27, 28, it's going to be a strong market. It's really just about timing. I'm a little bit more bullish on the back half of next year than he is, but we don't really disagree here. It's more about timing than it certainly isn't on direction. It's more about when it happens. And I would agree with you that there was an awful lot of supply that city had to work through. Okay, so.
And I'll say one thing too, is I've seen some headlines about Austin that people make too much of a demand slowdown in Austin. It's moderated, but I saw some headlines about people moving back to California again. That's crazy talk. Austin is still one of the top demand markets in the country. It's definitely moderated, but demand is not the issue in Austin. I don't think it's going to be.
Yeah, there's also, there's enormous demand drivers, and it's interesting when you sit in Chicago. That's where we're headquartered, but ironically, we don't invest here. It's just where our sort of 30 professionals who handle legal and accounting and client service. That's where our hub is, marketing. But it's our regional offices where all of our people who invest either execute business plans, find deals, and that's in these growth markets. That's in Nashville, it's in Charlotte, Tampa Bay, Florida, Dallas, to your point, Texas, Denver. That's where we're allocating the other 30 members of our team. And the idea there is you want your investment professionals to integrate into the community. There's a lot of things in business that are debatable. I don't know how I'm co-CEO. I don't know how I would defend, hey, we're all going to sit in Chicago, but we'll all be experts on these cities. That's ridiculous. By how? Because you fly in a couple days a month. That isn't it, right? And with Austin, when I go there, it's a lot like Dallas in the sense that if you're in Chicago, we celebrate if you bring in a company that has 1,000 people. That's a big deal. In Dallas, it's more like ho-hum unless it's 20,000, 30,000. They just built the new gig factory in Austin, and we're doing a deal close by because there's a huge need for housing. Who's going to house these tens of thousands of workers? And then, it just came out that now they're going to double the size of it, based on, Tesla's growth and need, et cetera. People don't realize what a true growth city feels and looks like if you're not in one. Would you agree?
Yeah, no, I mean, I started my career really talking to people in New York and elsewhere who just looked at these southern markets and they're like, people only live there because they have to, and they're not smart or rich enough to live in New York or Chicago or DC or LA or San Francisco, Seattle, et cetera. And it's really changed. I mean, if you still think if like I see a lot of mindsets that still think of these cities as like what they were in the 1980s and 1990s, and a lot has changed. I mean, these are especially the Dallases and Houston's, et cetera. I mean, these are big mature markets with a diverse job base. It's not I mean, Texas is not the Wild West of oil and cowboy boots anymore. It's been a really remarkable transformation and a growth story. I mean, these markets have bloomed from kind of awkward teenagers to now they're full-grown adults, and we see the stability. I think that comes with that. And I think also too, if you don't know these markets, you have to recognize like they don't look like some of the coastal gateway cities. Like they're Dallas, for instance, where I'm based. We don't. If people come to downtown, they go to the convention center, and they say, "Oh, this city's terrible. There's nothing around here." Well, Dallas is a lot of Sunbelt cities is not a city that's anchored into its downtown. Like it's an important part of it, but relatively small share of jobs are downtown. Like there's 20 different employment nodes in DFW with all their own kind of regional activities around it. Kind of like now what Elon Musk is doing out on the far west side of Austin, like building another employment node out there. And so that's just kind of how Sunbelt cities are more built, which is that you have a lot of nodes as opposed to like one, central anchor that drives those markets. So it takes somebody who really understands how these markets operate, because you can't just come in with the same strategy as in a New York or LA and expect that to work in Texas and in Florida.
So let's move on. We talked about what we're sort of certain of, the headline. Give me a headline in 2025 that you're not certain of, but you're gonna step out and pose a scenario that it could happen.
I think the biggest question mark is again, barring some sort of black swan event on the fundamental side, I don't think supply, demand, occupancy, rent is going to be the big surprise. I think and to your point earlier, David, I mean, we may see differences and nuances of the timing, but we know where this train's going. I think the bigger question mark is going to be on the capital side, and particularly how much we see deal flow pick up. Multifamily has been very similar to what you've talked about in the single-family market, which is that pricing has been relatively sticky. Cap rates have not expanded as much as interest rates have. And already we've seen numerous reports showing that now we've bottomed out on pricing, and now we're seeing some cap rate compression again, particularly for kind of institutional Class A and B assets that are in kind of these major markets, including the major Sunbelt markets. So now you see it to a point with, okay, it's the pricing seems to be sticking, but it's not translating to a lot of volume. And so I think the biggest question is, okay, do we start to really see more volume? And the challenge is you have groups out there that raise capital for distress, and they're not seeing a ton of that in the kind of the buy box they want. The better deals tend to be, that are out there tend to be competitive, but there's not a lot of them. And then you have a lot of, kind of potential distress, particularly in the busted value add category, that I think really still has to get kind of worked through. So again, to me, the big question is my view, put myself out there. I do think we're going to see a moderate pickup in sales activity this next year. I don't think it'll be crazy 2021, 2022 levels, but I think we're going to see a pickup in sales volumes. I think we're going to see that pricing is really going to, if anything, compress further for the most desirable assets, while it could expand more for these lesser desirable, more challenged assets in certain locations. So, but that's what I'm really interested to see play out.
I'm sorry, cap rates. You're talking about cap rates. Yeah, yes. And that we got that question a lot, and thank you for. We probably had 50 questions emailed prior, and just to address one of them directly. A lot of people have questions about cap rates into 25, and in particular, you mentioned this. The 10-year note yield's gone up more than cap rates, and so another way of saying that is the spread between the 10-year note yield and cap rates is incredibly tight, right? Right now, like today, the 10-year note yield's 4.3. I think cap rates probably are 5 plus or minus. Would you agree? When I say that, I'm talking about Class A assets in growth cities. I
Yeah.
mean, that's
Yeah. We're in the high fours
right.
again and
You
places
know,
like Dallas.
so you're talking about 60, 70 basis point spread. You know, historically, it's double that. It's much higher than that, and so everyone is looking at that because another way to think about this as a real estate investor is that leads to flat to negative leverage, right? Because if you're 70 basis points above, even in the safest asset, you know, I'll give you an example. We're closing on a 1031 deal, DST deal in Nashville, and we have a 145 over the 5 debt. But think about what I just said. You know, like lenders want to get paid, so they're getting 145 spread, and the cap rate spread is only 70, right? The 5-year note yield plus or minus today is probably like 415. And so 415 and 145, you're talking about a 5.6 rate on a 5.0 asset, right? So that's a negative leverage of 60 basis points. That's not normal for real estate. And there's a lot of reasons that exist. One of them is I believe the fundamentals are about to turn to be incredibly strong and a secularly strong, not a fleeting strong. I think we're going to have strong rent growth for 3 to 5 years. And I think the market's starting to pick up and understand that, and that'll keep that spread tight. The other reason is what you just talked about, which is there's just a lot of capital that's, you know, they thought they were going to be opportunistic, and it really hasn't happened. And so now it's investing in something. And so that it's really those two reasons. But I'm trying to, you know, and I'm going to pass it to you, Jay, but I'm trying to answer the question of where do you think cap rates are going in 25? They clearly are 4.8, 4.9, 5 right now. But to your point, it's low transaction volume.
Yeah. No, I think, again, we'll come back a year from now. We'll talk about why I was wrong. But my view on this is that I think you're going to see even more cap rate compression in the Class A, Class B plus, you know, recent lease ups that are well located in the major growth markets, and even in some of the coastal markets. I think we'll be back into the mid fours. Just because there's so much capital that all is chasing the same strategy right now. I mean, you look at the REITs, you look at private equity, you look at the smaller, regional groups that raise a lot of retail capitals. Like everyone's chasing that, and for a good reason, because they know relatively little of that comparable supply will be hitting the market in the following 3 years after that, and so they're willing to take it on the chin for maybe a year on the fundamental on the rent side if they believe in the longer term story. Plus, they don't have to worry about deferred maintenance. They have better rent collections, lesser issues with delinquency rates, and those Class A, Class B plus. I think, though, where I'm actually a little more curious about is you go down market, you get into I mentioned earlier, you have some of these kind of busted Class C deals, value adds that didn't pan out. I don't think the market's necessarily figured that pricing out for these deals yet. And some of that, by the way, is in the same markets, just maybe in the wrong submarket in Dallas or Houston or et cetera, or Austin. And those are those properties that need a lot of CapEx. They're more likely to have delinquency issues. And there's some real challenges there. And I think it's probably going to take a little bit. In the 2020-2022 period, you saw very low spreads between new construction and these challenged value add deals. And we're seeing that kind of widen again. But I don't know how it's going to settle out. Like you're going to have a premium or a significant discount, I should say, for investors to really jump back into that part of the market. And so that's the one I'd be watching closely.
I'm going to move us along. Over a longer period of time, Jay, what do you think, what topic isn't getting enough attention right now relative to multi?
I think the biggest issue is affordability, and it's not what people think. Affordability is a very bifurcated issue. I think we talked about this a bit last time, but I think it's so important to understand because what you were seeing in the market rate professionally managed segment is that affordability is reemerging as a tailwind again. And I say that because wages have outpaced rents for almost 2 years, and rent income ratios are back to where they were pre-COVID. And no one talks about that enough, but that's a real story. And it also correlates with the fact that you look at census data and Harvard Joint Center for Housing Studies done some analysis of this data as well. It shows you that the growth in renter households is really coming among those who are making $75,000 and up. And even the census's own data shows us that rent income ratios are basically the same as they were 10 years ago. The challenge has really been this bifurcation. So you can talk about affordability and everybody wants to say it's a challenge, and it is, but there's kind of two things can be true. It's a tale of two cities. We have millions of people who are able to afford today's market rent, and then you have millions who weren't able to afford it even prior to the inflationary run-up in rents, and that population is growing as well. And so we have a shortage of affordable housing among people who weren't living in market rate apartments to begin with, but who need quality housing. At the same time, you have a more positive affordability story among those who actually live in market rate apartments. I mean, and it's not just, you just look at the publicly traded REITs. I mean, they report rent income ratios, high teens, low 20s. And that's representative of the broader market. I mean, that's just the reality. And so I think when you think about this segment in particular is, yes, we have an affordable housing challenge and shortage. But again, for this part of the market, it's become more of a tailwind than a headwind. And I think that's going to be a good driver of these next few years.
Yeah, and that's why I think we're the beginning of a secular bull market in rents, because you have supply that's going down quickly. I know it's hard for people to process that today. I keep getting questions like, what about Orlando? What about Austin? They're all the same. There's a lot of supply right now hitting, and there's nothing behind it. And so it's hard to look around the corner, but I'm telling you, you're going to feel very, very differently in a year. And in 2 years, you're going to see in the headlines, everyone's going to be screaming about there's no affordable housing, we need rent controls, we need this, we need that. Like, that's all coming. And there's nothing that can stop it. And then to your point, what I'm getting at is, once supply goes down and demand stays constant, stays fixed, because I don't think we're going into recession, so demand will stay high, then you have to ask yourself, but do people have the ability to pay? And that's what you're addressing now. And the answer is yes. They have the ability to pay more rent. The rent affordability ratio in the low 20s, that's really low. That's healthy. That means that I saw it in 21, 22, it was high 20s, low 30s, right? And it was very, very different. And in that case, they don't have the ability to pay more rents. And that's something you should be thinking about, whether you're investing at Origin or anywhere else. Look at the affordability ratios of what you're getting into, because if you're doing a value add at a deal where affordability ratios are 30, but you're going to improve units and raise rents, they can't afford those higher rents.
Yes,
it's not going to work. You need an entirely different renter. All right, so I'm going to move us to the last question. Well, go ahead. You were going to say something.
Yeah, I was going to say, I think you're right. And that's where I think where you're going to see affordability challenges going to be more concentrated in that part of the market. And I think, not to get too philosophical here, but I think that's going to be a real challenge from a policy standpoint as well. And for investors is we have a lot of apartments our last big supply wave was in the 70s and early 80s. Those apartments are 40, 50 years old. That is going to be a real challenge because they need a lot of CapEx. They have renters who are paying a higher share of income on rent. And you can't just go in there, do a big value add renovation, and expect renters to be able to pay more. And then even if you turn over the units, then you get other policy implications. I'm not sure you can find people who in certain locations to pay more. So there are real challenges out there. But again, it's different from the Class A, B+ market that we're talking about. Very different stories.
Yeah. And before I take us to the last question, the other thing that I see a lot, we talked a little bit about negative leverage, the spread of cap rates in the 10s and 5-year note yield. But a lot of buyers are looking at replacement cost, and they're really using that as their compass. And they're saying, wait a minute, in 21, I had to pay 25% above replacement cost. Now I can pay 3-5% below in certain markets. It depends on construction, but in certain markets, some of the high-rise podiums, that type of product is trading at or below replacement. And they're using that as their compass. Are you seeing that?
Absolutely. I mean, I think that's a big challenge, by the way. Another reason why we're not going to see more construction is because the LP investors know that, or they're in their mind is that they can buy cheaper than they can build. And so because of that, I think that's also driving more capital to the acquisition market for the time being. And but that's a big part of the thesis, is that buying cheaper than you can build it. And by the way, as another aside, I think that's ultimately going to do is put a lot more pressure on builders to find cheaper ways to build, more kind of cookie cutter, survival of the fittest, more efficiencies of scale, all that other kind of stuff. But it's not gonna happen in the volumes we're seeing today.
So the last topic, then we'll go to Q&A, is what do you see as the biggest headwind to multifamily in 25?
Yeah. Okay. So in 2025 specifically, I think it's pretty simple. I think it's just it's the tail end of the supply wave is still going to be the biggest headwind on the fundamental side, and then on the capital side, I think it's an issue of honestly being able to execute the strategy. That's the headwind, of being able to raise capital and execute the strategy of that everyone believes in. There's a great survey that John Burns of CRE Daily did. It's an investor sentiment survey, basically, do once a quarter. And what it showed was that everybody wants to be a buyer of multifamily, but that everyone's having trouble accessing capital to execute that strategy. And so I think the real challenge is going to be, okay, the real opportunity is that who can actually execute this strategy in a way that works? And everybody wants to do it, but not everyone's going to be able to.
Yeah. And you and I haven't touched on construction costs, but I see a potential headwind if we enact tariffs, and they're large. That can be inflationary to future construction. By the way, for those that don't know, construction pricing went down last year, 3 to 5% nationally. In certain markets, more. Florida, more, for example. Phoenix, more. That was more like 6 to 10%, which is pretty remarkable. But if you think about it, that was coming off like enormously inflationary years in 22 and 23. But going forward, we did extensive underwriting on this. We think at origin it's going to revert back to kind of a normalized 3 to 5%. But we're factoring in tariffs. Like if there weren't tariffs, we would kind of see a zero for this next year, and it's based on, to your point, Jay, just a lot less starts, and less starts means less need for labor, less need for materials, et cetera. But I think that'll turn around if we enact a lot of tariffs.
Yeah.
I'm going to move us to Q&A, and I'm going to actually I'll do them, but I'll give most of them to you. I want to start with an order. So the first question is, I think we might have addressed this, but we can do this quickly. I hope I'm pronouncing this right. Manon, thank you for your question. He has a question about supply in Austin and how that will affect rents. And I think we did cover that. But maybe you can just say it one more time.
Sure. No, it's supply in Austin is about 9% of the existing stock. And so for every 100 units we have, we're adding 9 more. So it's a pretty big number. And so what that's doing is essentially, there's more options. And I think, by the way, these renters can afford to stay put, but you go somewhere newer for a better value, that's putting downward pressure on rents. And so it's not getting worse in Austin. And, I think, David, you and I both agree it's going to start trending up better this next year. I think it's a question of when it really turns, whether it's, late 25 or 2026. But its supply is going to drop off there like everywhere else.
Jesus asked a question about the average mortgage rate in the U.S. I would answer that's 5.5 to 7 if you have good credit. Would you agree?
Yeah, and then the other problem too is that, remember, it's not just the mortgage rate, but the home prices have gone up, insurance costs have gone up. If you're paying less than 20% down, you're paying obviously higher debt costs per month. And so it's the all-in cost, like I mentioned earlier. I mean, you're in the 4 digits per month versus renting an apartment or single-family home.
Yeah, and what Jay means is, on average, it's $1,000 a month more to own than rent a like-kind home in most of the cities in the U.S., which is, it's the widest it's ever been. I don't think it'll widen next year, but I'm also bullish on rents going forward, and that's why. But I also don't think it's going to change much either. I think it's just going to kind
Yeah,
of stay where it is, wide.
I agree.
Um, Rob, thanks for your question, and thanks for being such a great partner, Rob. He has a question about why supply would increase going forward if there was inflation and the Fed keeps rates, high at the front end. Why would builders come in even next year? That's his question.
Well, I mean, remember, most apartments apartment builders are mostly merchant builders, and so they get paid to build, and so they're trying to find ways to build, and they will find ways to build. But I think the ones who get by are going to be generally larger players with more scale, and they're still going to come in at reduced volumes relative to what they had previously. But what they're really trying to do, and even in that type of environment, they've really shifted toward trying to build more workforce and affordable housing, more with tax credits, tax abatements, any type of program that helps reduce their costs or their basis is going to be, really what gets a lot of focus right now. Or these kind of unique deals where you can build at a lower cost, get a lower rent. But it's a very challenging environment to do any of these things. It's just that's what everyone's pivoting toward.
So we've approved two new development deals in the last 2 months. One is an opportunity zone deal in Phoenix. It's a mall that's being reinvented as mixed use, great area already. We believe in the area. And the return on cost, because we'll get to this, but someone asked a question about yield on cost and we're looking at, but so our underwriting, which is fairly conservative, we're looking at a 6.3 to a 6.4 in a good area in Phoenix. I think it's probably a 4.7, 4.8 market right now. So that's the type of margin we're looking for, but also our lens is to have an asset you want to hold long term, and QZ you have to. And then similarly, we did a deal at about a 6.4 non-QZ in a true barrier to entry location in Scottsdale. That deal, I mean, it's a larger deal. It required over 50 million of equity. And so like we are active in the development market. And maybe I should just answer this question because Reed asked it. Cap rates, and Jay, I agree with you. They're sort of 4.7, 4.8, 4.9, 5. That's the last indication. But admittedly, most of those transactions happened when the 10-year note was 3.8 to 4, not 4.3, right? So I will absolutely admit that, because typically what's happening right now in the market is there's flurries of activities in sales at 4% or lower in the 10s. That's where it's happening because sellers are holding on and banks are kind of letting them, and people get more optimistic as rates drop. And then when rates go back up, everyone just kind of holds and hopes. That's been kind of the last 2 years. But Reed's question is, if you're right, Jay, and cap rates are kind of headed back to the mid fours, does a 6% yield on cost make sense? And I don't know if they're going back to the mid fours, first of all, but I can tell you a committee, and I just did. We're approving deals in the sort of 6.3, 6.4 range. To do that, we'll look at 100 deals, and most of them are at 5.3, 5.4, 5.5, 5.7. We'll take the best ones, but the thing I'm really looking at, Reed, more than the yield on cost, is that captures the margin at a point in time. I want barrier to entry markets that are going to be growth markets for 10 years, 20 years, 30 years. I want assets that will endure over time in great locations. So if you underwrote or brought me a 6 yield on cost that's in an irreplaceable location in a growth city, I would look at it. But if it was commodity, absolutely not. And candidly, I wouldn't be interested at a 6.5 either. So that's where I am with that. In terms of Rob asked another great question, I'll forward to you. Are regional banks sitting with extend and pretend loans, and how is that going to play out in 2025? And you and I talked quite a while offline last week on that one.
Yeah. Yeah. And let me just quickly add the last question too, is that on the builder thing is obviously your strategy is like you're building in the 26, 27, 28 anyway. So it's a different, a lower supply environment at that point. On the banks. So it's a great question. The extend and pretend, it's always, it's funny because the headlines sort of make it out like all these are banks doing all this stuff. Banks are mostly not the ones that are involved in this. I mean, the bank delinquency rate for multifamily is like 50 bips. It's what I think the lowest or second lowest of all the bank lending categories the FDIC requires the banks to track. And so we aren't seeing a lot. It'll go up a little bit, but we're not seeing a lot of multifamily noise. And most of what they lend on is either construction loans or it's kind of more mom and pop regional, smaller older apartments. The real issues where you see extend and pretends are more focused in on the debt funds, where we've seen a lot of short-term floating rate debt issuances, and we've seen some of the debt funds that have been working with them to because basically they have no incentive to foreclose on these guys, take back the keys. It just impacts the rest of their loan book, and then also I mean it's in their best interest to sort of ride this out as long as they can. So some of them may be situated to take over and run the asset. Most of them are not. But ultimately, I think what we're going to see is that it's not so much like uppercase D distress or like foreclosure situations. But I think this next year we are going to see, more forced sales where eventually like you get to the point, all right, the loan is now, or I'm sorry, the property is worth more than the debt. We need to get this thing moving along. So I do think you're going to see more of those situations, particularly in the value add space I mentioned earlier. But I don't think it's going to show up in the form of these kind of mass, write downs and traditional distress like we saw in the great financial crisis.
I had a question from Manuela about investor appetite for multifamily real estate investment in 2025. I think that it's already picking up. Like just to give you an example, the deal that I was describing, that deal was too large for our fund. It required over 50 million of equity, because to Jay's point, banks still aren't lending, to 65. This is a exceptionally well located, high margin deal, but on construction, you're lucky to get 55, right? And we don't use pref or mezz or anything like that. So these deals require a lot of equity because you're just not taking a lot of debt risk on these deals. We filled that deal in 10 days. It was too big for a fund, so we just brought it to our investors. And yes, we have thousands of investors, but the reality is we could have raised a hell of a lot more. So I think good deals absolutely find equity now. I also think, and I was talking to an investor yesterday. He was thinking about investing in our third opportunity zone fund, and he was asking about investor appetite for qualified opportunity zones, and a lot of that is based on if President-elect Trump extends the law, and by extending the law, you extend the deferral period. Whether he introduces the other things or not, it really adds to the benefit of that program. But what I said to the investor, and I want to hear your thoughts on this too, but it's not just about real estate. I see it in every asset class, whether it's crypto, the NASDAQ, the Mag 7, whatever it is. Investor appetite into an asset class seems to be the strongest when it's irrationally priced high. So the same investors that weren't so, interested in investing in Bitcoin when it corrected from 60,000 to 16,000 are now super excited when it's 100. Or when the NASDAQ, it wasn't so long ago, the NASDAQ corrected violently in 22. If people on this call, if you were in the NASDAQ in 22, you lost 40%. Some of the stocks more. Facebook went down 70%. I bought it at $90. But now people are really excited at 600. And it's just interesting. It's like FOMO and this idea that you have a rational investor, it's not true. Like investors tend to chase the hot thing, right? And so what I think is going to happen with multifamily investment our fundamentals are strengthening, and it's gonna really turn quickly. And now's actually the time. You're not gonna want to wait, but people will wait, and they're gonna invest, a hell of a lot in 26 and 27 and 28. That's what I see coming.
Yeah, no, I wouldn't disagree with you too much. And I think the other thing too is people look at, particularly if you want to be in real estate of some type, you look at your options. Obviously, people are still nervous around office. Retail's hit and miss. And it becomes industrial, it becomes rental housing. I think that's still pretty much the case. And I think you look at it just fundamentally, if you're an investor, you think people can work from anywhere, they can shop from anywhere, they can eat from anywhere, but they need a home. And apartments provide a home, and so I think you look at it simply as people need homes. Supply is going to be going down, and I don't think it's that complicated. At the end of the day, there's some FOMO involved, but I think it's also just there's a simple logical case for investing in rental housing as a structural. A structural case for rental housing over the next 10 years at least.
James asked a question about U.S. military involvement overseas and how it could affect multifamily demand. And James, I don't disagree with you. Like these massive black swan events could affect demand, the economy, all of it. But as an investor, I can't make decisions and plan for that. I can't base my investment strategy around black swans. What I can do is invest with edges, meaning margins on development, paying the right price when I enter an investment, when Origin enters. Like I said before, making sure that you have barriers to entry in your assets. And there's all kinds of barriers to entry. I'll mention one that isn't thought of a lot, but in Texas, for example, we're one of the largest investors, both in development and stabilized. They're called PFCs, where you're not paying property taxes, and it's Houston and Austin and Dallas. It's their attempt to create affordable housing. And so when you're investing in those areas, if you choose the areas correctly, you're getting rid of your biggest expense. And then you really have to know the nuances of the program. But if you're in the right ones, because they're not all the same, they're quite complex. But if you pick the right locations with the right PFCs, you're incredibly insulated from what you're talking about, these black swans. I mean, and as the areas change and grow, it's almost like you've been subsidized along the way. So like, it's just an example. But like, I would just tell you that as an investor, you have to use the same fundamentals. And I can't, here's another story. Sam Zell had a publicly traded REIT called Equity Commonwealth. And I'm going to get the date wrong, but I think it was sometime in 2017, maybe. If I'm wrong, tell me, 2016, 2018. But he went into an all cash strategy because he saw that, that all these bad things were going to happen, and he was going to buy stuff really cheap. And it just didn't happen, right? And so, and it's easy to be like, well, wait a minute, it didn't happen, so what? It's not so what. He should have been making 10% every year. And so I think it was a $3 billion cash position. So 3 years later, you're $900 million behind. And, another way of looking at it is you got to buy stuff down 30 to be break even. You know what I mean? So here's my point. Not investing isn't an option. You can change the way you invest based on your outlook. And I have, right? So at Origin, we went heavily into credit in 21 and 22 because I didn't want to be first loss equity. But I didn't stop investing, right? That's a different strategy, and in my opinion, a failed strategy. What do you think, Jay?
Yeah, no, I agree. I mean, you've seen throughout this last cycle, you've seen a lot of creativity and different ways to invest in multifamily, whether you're, short-term risk, long-term risk. We've seen, like you talked about, I've seen a number of equity players move into the debt side or trying to buy bank loans, creating debt funds particularly opportunities that you may eventually become the equity on. And so, yeah, I think at the end of the day, it's like, do you structurally believe in the need and the demand for rental housing? And if you think the demand is there, you believe supply is coming down, then you find the best vehicle that you believe in to invest in that space.
Yeah, and at Origin we do both. We have credit funds that's all multifamily credit. We issue loans. We buy Freddie Mac bonds. And the nice part is we get a tremendous amount of data from that. When you buy a bunch of Freddie Mac bonds, you're getting hundreds of thousands of units and the data from those units, right? So it helps inform us on both sides. But I get this question a lot. What would you do now? And I think it's going to be very consistent. I had look, I don't know you as an investor, what your preference is. Like if you're a very low risk investor, you should be in credit all the time because that's really what you're most comfortable in. That's the safest investment. And you can get 10, 11% net returns in credit. But what you need to understand is they're not tax efficient. We're all taxed investors. I don't think there's any pensions on this webinar. And so when you're in credit, you're gonna pay the ordinary income tax rate. There's nowhere to hide. So if your rate is 30%, 35%, and that's very different than equity, where you have depreciation and other things that can really offset that kind of indefinitely. And so you have this free ride. That's why real estate's so wonderful as an investment class. So I personally like equity more right now because I think we're in the beginning of the secular bull market in real estate, both rents and valuations. I didn't feel that way in 21 and 22, but valuations are lower. We haven't really talked about that, Jay, but like in our funds, our equity-based funds, we've written down the equity in our equity deals, 12%, 15%, 18%, and it's solely based on multiple. At the high, we were using a 30 multiple. Now we're using a 20 multiple. Well, that's a big difference. Would you agree? I mean,
Yeah.
30 feels better than 20 when you own it, right?
Yeah. No, like I said, I don't want to be repetitive, but I mean, I think that we've seen an inflection point in the market. I think there's a long-term structural opportunity, and I tell people all the time, you can be successful in all different types of strategies, different markets. Just find something you have conviction in and pursue it. But I'm in this space for a reason. I'm a believer in rental housing.
Yeah. Well, I had a comment, and I'm going to just address this because Frederick, he wrote FOMO in quotes and a question mark. And one of my pet peeves, Jay, is there's so many acronyms thrown around all the time, and I'm guilty of this too. I did it, PFC, whatever. I mean, and so FOMO, can you tell everyone what that means? Because I think he didn't pick up on that.
Oh yeah, the fear of missing out. Yeah. So you've missed out on the acronym here.
Yeah, exactly. Well, Jay, thank you so much. I really appreciate your time. I know you're in ever higher demand, and I really mean this when I say it. I rarely read anyone's posts because I don't think they generally offer much new, but I do read yours. I really do. And I think they're thoughtful and they're well researched. And I'll tell you another thing that I respect about what you do. You change your mind, and I've seen it in your posts. You did it today or yesterday, and admitted that maybe I should have looked at it this way, and this is why. And I just think that you're intellectually curious, and it serves everyone. So thank you for all of that.
I appreciate the kind words, David. Thank you so much, and thanks for having me on the webinar.
Yeah, and we appreciate your time too. Thanks for spending it with you. We will send the recording out, and have a happy holiday, everyone. Bye-bye.